Welcome to episode 1 of the Naples Chad podcast. I'm Chad Phipps, a real estate agent with John Irwin Properties here in Naples, Florida. Pretty excited today to have one of my trusted colleagues, Steve Fishman with Buckeye Lending. I've known Steve for quite a long time. Steve's been in the mortgage business for a few decades, and he's definitely my go-to person amongst other assets, but somebody who I trust, somebody who I can speak with. Answers his phone, is responsive, and has a wealth of knowledge. So welcome to the podcast, Steve.
Thank you, Chad. I appreciate being here.
It's good to see you again. It's it's funny because we're both originally from Ohio.
Yeah.
I'm from Northwest Ohio. You're from the Cleveland area, and then we both made a decision at some point to move to Florida and to get into some better weather.
Yeah, I had enough snow.
Steve, it's interesting because I know that you're licensed in both Ohio and in Florida. And
Correct.
If you just want to give us a little bit of background of you in the mortgage business.
Yeah, I've been, I've been in the mortgage business just 30 years. And like you said, a few decades. I stumbled into it after I sold a previous business, which was insurance, and picked it up and ran with it. It's become my lifelong career, and most days I love it. And I've seen the cycles, I've seen the ups and the downs, and real estate is local, very local. So some markets are booming and some markets are a little slower, and it's just the way the industry works, and you go with the flow.
Right. No, it's a good point, and I appreciate it because it's I think in this business, one of the things that's interesting, you're talking about local, and that a lot of the people that I work with here in Southwest Florida generally live up north. It's pretty rare in my 22 years of real estate experience that I find somebody that's local, that was born and raised here. A lot of times when people are trying to find, lending options, they live up north and they want to purchase a condo or a single family home down here, and they're kind of like, certainly they bought and sold real estate up north, but they may not be familiar with the process here. And I think that's why it's important that I work with somebody like yourself that's been writing loans here in the state of Florida, but also understand kind of the minutia up north. I wanted to know too, like, if you could explain for our viewers, like, what is the difference between, say, like a broker or somebody that works for a bank or a lending
Sure.
institution? What do you do differently, and what do you have available to you that others don't?
Well, before I do that, I remember we had a scenario. One of your buyers was buying down here, and they were using a big bank, one of the big 4 banks up north, and they wouldn't lend on properties that were on the water, if you remember. And that's just because they don't know. So the simplicity of it is, there's a multiple different types of lending institutions out in the marketplace. So you've got your typical bank, your corner bank. And they're pretty vanilla in what they offer in most cases. They'll offer jumbo, they'll offer conventional, they may offer government funding, but some of the big banks don't even offer that. And again, if you don't fit in their bucket, then they're not an option for you. And then you have some more regional banks, which may have a little bit more flavors. They might offer additional products outside of what the big banks do, and they may be a little bit more accustomed to the region. But again, if you don't fit in that bucket, then there's not an option for you. And then you got credit unions, and credit unions are member owned, so they sometimes will do things that the banks won't do, but there are still restrictions. And credit unions sometimes fill a void. They do a nice job at doing equity lines and things like that, but again, they're still limited to pretty much cookie cutter products. And then there's the mortgage companies. So you've got mortgage companies that all they do is mortgages. And if they don't do them well, then that's the demise of this, that entity. But some of them are monster size, and they just mass produce, mortgages, and the customer's just a number. And again, if you don't fit in that mold, thank you and goodbye. And then there's brokers like myself. So as a broker, I have relationships with over 100 different investors. And some investors are strictly what we would call non-conforming, which is more for investors or self-employed or outside of the box stuff. And then we have the traditional, conventional, jumbo, FHA, VA, USDA, all the standard stuff that everybody else does. The difference between what I typically can do is versus what they can do is there's a thing in my industry. Are you familiar with what an overlay is, Chad?
No.
Okay. So if I were to ask you, what do you think the typical minimum credit score for an FHA loan would be? What would you guess?
I'd say it's probably 675.
Okay. The reality is it's 500.
Wow.
Okay. Why is it 500? And why don't you know that? It's because most people don't do that. I do that. Okay. I'll go down to 500. I don't advertise it. I advertise 550, but I go down to 500 with the right type of criteria. And that's called an overlay because FHA will lend down to 500. They put a lender will put this elevated level of appetite for risk in place because that's not what they want. So the corner bank might have a minimum score of 580 or 620 because they don't want to go below that, or 650 or 660, whatever it is. We don't have those overlays as brokers. The way the rules are written is the way we administer them to the consumer. So when a particular lender may say no, that's them. Because I go by, when I do my marketing, it's no is not always no. So we have this conversation. I turn a lot of no's into yeses. And some people don't really qualify, and they shouldn't. Okay, but we take that no, we turn it into a yes because they had an elevated level of appetite for risk that they didn't want. We still qualify these borrowers, and we were able to proceed with one of my investors. So the fact that I have all these relationships, it opens up and broadens opportunities, and rates are more competitive, products are more competitive. We have speed and efficiency that some of these other banks that they might have a clog in their line somewhere and it just stops. We don't run into these situations because it's we know where to place these files and how to get them through quickly.
No, I appreciate the explanation. It makes a lot of sense. You have a lot more options accessible to you and to customers. I think that's the other thing that people forget, and I think I always say in a vacuum, there's this interesting thing that occurs in my 20-some years of experience with mortgage people, and I'm not saying yourself, but others, where they just beat their chest that they can close a loan in 30 days, or I closed a loan in 21 days, and I'm like, yeah, in a vacuum, if everything goes perfectly, if all paperwork's submitted, if everything's done, if there's no encumbrances, if there's no holidays, if nobody's on vacation that's underwriting that loan, you could close a loan in 21 days. But by and large, just as a safety net, I generally look for like a 45-day close. I think that's sufficient enough time for underwriting. The other thing to think about is the protections that are offered like in a contract. So when somebody purchases and they're using financing, I will pretty much push for a 45-day closing from the effective date when all parties sign. And that gives the bank generally 30 days to underwrite the loan. That's the protection. That's the finance contingency period. But I've had absolute nightmares and horror stories where you have bank XYZ up north, and I shouldn't say always, but there's some customers that will have a bank that's based in Pennsylvania or New York or New Jersey or Connecticut, Illinois, and they'll say, well, I'm also licensed to write loans in Florida, and then it turns out maybe they wrote a loan in Florida, but maybe it was 4 years ago, and they're not up with milestones, SIRS, paperwork, title, estoppels, how things work. The fact that everything is gated here with an association and a management company, and there's a myriad of hurdles that you have to walk through. And effectively what happens is that they'll attempt to communicate with the people down here on the ground, because once that contract is signed and it's done, and we've done the inspections, the mortgage process is over here. And that's why I need a trusted partner that is quarterbacking the situation. They know exactly where the loan is at all times. My horror stories are, and why I push somebody like Steve Fishman on this, is that I need somebody that I can communicate with that answers their phone, that replies to texts and calls and emails, and at any given point can literally tell me where the loan asset in the process is underwriting. Because we're not buying, I always say this, we're not buying a t-shirt, we're not buying a pair of sneakers, we're buying a several $100,000 or $1,000,000 property. You have earnest deposits in of between 5 and 10%, and that money is potentially at risk.
Absolutely.
And so for me, like, I need a quarterback. I need somebody who can tell me what's going on. Hey, buyer hasn't submitted these 3 pieces of paper. I need your help in gathering these things so I can submit to get this through. And having that line of communication, having that direct contact with you is important. I have too many people up north to say, oh, my bank writes in Florida, and I make an introduction to the person up north writing the loan, and then it's like crickets. And they may start the loan with that person, but then it's off to some team, who knows where, with big bank
Right.
or whatever. And people sit down for an 8-hour shift, and they're working on hundreds of files at a time, and I can't get a human being on the phone to tell me what's going on with the loan, where are we at, that type of thing.
Right.
So I think that's one of the reasons for me, it's like peace of mind. And being in this business for a while, it's a lot of trial and error. It's the same thing with the handymen that I use, the plumbers, the electricians, the title and attorneys
Sure.
that I use. I need somebody that I can count on and that I can know, and then I can vouch for Steve Fishman and Buckeye Lending. Like, I've had several deals with you. My customers are happy. You refied my own loan. I remember, waiting and waiting and waiting as rates were dropping and trying to find the right strike point. And you're effectively like, I don't think it's going lower than this. We need to refi right now. And we did. And I'm super happy that I did that. So any comments on your ability being here in Florida and working in this market and understanding the process versus, because I know there's a lot of times where people have started the loan process with somebody else up north, but then they fall into peril and it's an issue and you have to come to the rescue. Maybe speak to that a little bit.
Well, there's a lot of working parts. And Chad, you know my process, so you know that you're going to hear from us at least once a week, if not more. So that being said, back to the real estate is local, there's things here that those northern banks have no idea that are, when they quote a transaction, they may not even quote it with flood insurance. And flood insurance is, I don't want to use the word problematic today, but it can be a deal killer if it's that expensive, So these are all the things that loan officer sitting in that Connecticut bank doesn't know that I better price it with flood insurance. I better price it, at $8,000 a year for homeowners insurance, and all these things that will ultimately affect the debt to income ratio.
Right.
Being here in the market, I have access to the data. I can pull it up and see that it's in an AE zone for flood, or it's an X zone, so I don't have to worry about it. Being here, I know that rates are elevated with regards to insurance. So those are some of the things. And then, what's an average association dues? And does it require a mandatory membership into a country club or some type of membership that, again, is a potential for ratio denial? So all these things are big parts of that moving monster that you talk about that we have a little bit of insight into, and when we quote them, we kind of take it into consideration and maybe overly qualify them to make sure that those added costs will support what they're trying to do.
I just had a thought, and I'm thinking about maybe a first-time home buyer, somebody that's researching the mortgage process. So maybe if we can water it down for just a quick moment, can you explain just at a cursory basic level the debt to income ratio and what you guys look for maybe somebody that's watching this that doesn't understand what that means and how that works and what lenders are looking for?
Yeah, absolutely. So as simply as I could put it, the debt ratio that we qualify a buyer on is their total outgoing debt on a monthly basis. So credit cards, car payments, student loans. We don't necessarily look at the utilities and things like that. We take into consideration with regards to the new debt, the house, what we call PITI or PITIA. So principal, interest, tax, insurance, or principal, interest, tax, insurance, and association. So those are factors. So we calculate the new mortgage payment and all those debts. We calculate a car payment, and then anything else that's on the credit report. And in most cases, program-wise, let's just use conventional as the standard across the board here. They want that consumer to be at 50% of their income to be not to exceed 50% of their debt, if that makes sense. So if they make $10,000 a month, their debt can't be more than $5,000. Okay, simple numbers. And that's the top of it. That doesn't mean that they qualify. So if 45 is more optimal, so 45% or 4,500 of that 10,000. So those are the, you can't make 10,000 a month and spend 10,000 a month on all your debt. That the programs will not allow that.
Right.
Now we do have programs that look a little bit higher. Your FHA, your programs like that, they'll go up to 56, 57% of the debt to income. VA doesn't really have a debt to income. I mean, they do. But I mean, I've seen 68% debt to income approved for these veterans. And VA is one of the best, absolute best programs that we offer. If you're eligible for it, absolutely positively take advantage of it. But so each program has their own set of rules for debt to income ratio. Jumbo has a set, non-conforming programs, they have a set of debt ratios. So it's very specific to the individual and the program. And that's where the pre-approval comes in.
What about like baseline credit scores and things like that? I know you mentioned that with FHA, you could bottom out at like 500 and things, but like for a conforming or conventional product, what's the kind of basis for credit score so people have an understanding if they want to start thinking about purchasing?
So conventional starts at 620.
Okay.
So the minimum you can have to even be eligible, doesn't mean you qualify, just to be eligible is 620. VA doesn't have a score requirement. We talked about FHA, which is 500, and then USDA, which we really don't use a lot of USDA, which would be more towards like into the estates and stuff. There are options for that, but they kind of mimic the FHA requirements, but they do want to see a stronger borrower. So they'll go down to 580, but they prefer something above 640 from my experience. Okay. Jumbo, they like to see 680 and above for those types of scores. They'll go down lower, but it does require more money to be put down on that type of trans. And then there's non-conventional, non-conforming loans, which is becoming much, much more popular in the marketplace again, especially for self-employed and investors, where they'll go down to, it just depends. I mean, we can go down as low as 580 on some of those programs, but self-employed individuals don't always show income the same way as a W-2 employee, right, yeah. So we get a little bit more creative in how we calculate that income.
I think one of the other things that I wanted to kind of segue into, now that we understand kind of like how the programs work, what debt to income ratio is, what minimum credit scores are, all you read about today is interest rates and what they are and what they were and the Fed and the 10-year Treasury and all this other jazz, but just at a basic level so people can understand, because you could get a lot of people saying, well, I'm just going to wait. I'm just going to wait. I'm going to wait for the Fed to lower the rate. I'm going to wait for this. I'm going to wait for that. And if you could just kind of water down for our viewers, sophisticated viewers will understand because they've been in this process before and they may follow markets or treasuries or things like that. But can we water down like where things are and kind of what your ethos is right now when people are, I don't know if I want to pull the trigger right now. Like what is the guidance that you might offer somebody that's kind of in that mindset right now? So just to set the record straight, this is my professional opinion. Okay. So let's tap on let's touch base on the what the Fed is. Okay. So people, they'll hear the Fed's not budging or they've increased or whatever it is. The Fed is not an index that drives mortgage rates. Just to clarify. Okay. So what is the Fed? The Fed is what we call an overnight rate. Okay, so when the Fed issues a rate, which is currently 4.5%, that indicator tells the marketplace, the banks,
what prime is. So prime is always 3 points over the Fed rate. So 4.5 is the Fed rate. Prime is 7.5 today. So that affects credit cards, some car loans, equity lines, but not first mortgage loans. Okay, completely different index. It also is what the federal government lends money to the banks on an overnight rate. So it's the open window that the federal government will lend the money to the big boys, and then they turn around and lend it at a premium. Okay, mortgage rates are based off of a thing called mortgage-backed securities. Okay, completely different index. At my office, I have 3 screens. One screen is strictly mortgage-backed securities, and they're trading all day. And when it's like a Christmas tree. When it's green, it's beautiful because things are improving, and when it's red, we don't like it. Okay, yeah. So there's flashing lights on the screen constantly, and we've seen some improvement. I think I just read that we're at the lowest in 8 months right now rates, and they're averaging, for a perfect scenario in that like 6.7, 6.8 range. Okay,
for a 30-year.
Yeah, as of last week. Okay, so I haven't looked at anything today. But so that being said, Fed and mortgage rates, 2 separate indexes. Now, if the Fed says, okay, let's lower the rate, will that affect mortgage rates? It could. It could. We could start to see it. Mortgage rates are determined by data. We've got inflation. We've got things in other countries that are affecting mortgage rates. So on a daily basis, depending on what data is being provided, rates will fluctuate up and down. But if the Fed says, okay, we're going to reduce that federal rate and lower prime by 0.5 point, I think we'll see some relief over here in the mortgage side, but there's no guarantee, okay? But I think we'll definitely see consumer confidence start to increase too, okay? We were touching base about it earlier, and what I think, and again, professional opinion only, is especially in Southwest Florida, with the amount of houses on the market for sale, it is an absolute, it's an huge opportunity for somebody to step in and buy today. And if they don't like the interest rate's temporary. The sale price on that house is not, because we're in this cycle where these houses that are sitting on the market, and you correct me if I'm wrong, they will start to dry up, and there'll be less inventory. And what happens when there's less inventory? Prices start to go up.
Sure.
So it's an optimum time to negotiate. Negotiate a seller concession, negotiate an excellent sale price, all the things. And if it's going to cost you a little bit in interest rate now, you can always go back and refinance later. But if you wait for the rate to come down, I think your sale price and your options for concessions and things are going to increase. Yeah,
I think that's almost like if everybody was waiting for Black Friday to purchase the television, the Samsung at Best Buy, like you have your eyes on this amazing TV, and everybody just waits, and then effectively midnight, Thanksgiving, doors open, and they're all gone. And not to say that housing's going to fly off the shelf overnight like TVs at Best Buy on Black Friday, but it's a good analogy because everybody's kind of waiting on the sideline, waiting. And we have an old adage, you date the rate and you marry the house.
Right. Date
the rate and marry the house. And I was in some interesting products before. When I purchased my condo in 2004, I was in 2 interest-only products that were tied to the LIBOR index, and it was pretty static, and I really didn't have any fluctuation over time. And then I waited until it made sense to refi with you. But let's talk about some popular things right now. What are some popular product, maybe for that person that's buying the second or the third or investment home or a second home, vacation home. I know potentially like a 5/1 ARM or some of those things, if we can kind of water that down, or you can walk people through some attractive products that you're currently putting people into right now.
Sure. So you mentioned a 5/1 ARM, and each product has a different version of that. So there might be 5/1 ARMs they're back in the marketplace, conventional, we'll say. And I don't find them to be extremely competitive across the board. In some cases, they're actually priced higher than a fixed rate. But that, again, depends on the index that they're, LIBOR is gone. LIBOR was corrupt and now it's gone, okay?
Yeah.
So there's a completely new index that runs the adjustable rates. But like I can tell you right now, I have a program for government loans for 3 and 5 year ARMs. And some of those ARMs start at 5%. And the nice thing about that is I can qualify you on 5%. With the government loans, we can use that start rate and qualify that debt ratio. Under the conventional, I have to use the adjusted rate. So even if it starts at 6 and the first adjustment is 2 points, I have to kind of use that higher rate to qualify them because the rules are different for the programs. So in some cases, there's not an enormous advantage to it. Okay. It just depends on the consumer and the rate and everything. But there are some good programs with adjustable rates. And then another scenario would be maybe a buy down. If you can negotiate somebody to the seller to cover some buy down points, you can take something that's in the mid 6s and potentially get down to the high 5s.
Okay, so let's explore that scenario, and this is something that's been popular. I know builder developers, they have their own in-house kind of operation. So if you buy with Pulte or Lennar or Taylor Morrison, and you want to get new product, new construction, they'll say, well, if you use our in-house, we'll wipe away these closing costs and this type of thing, and they have buy down. So if you're going to go from let's say you go from 6 1/4 to 5.9. To buy down that difference, what is the dollars usually, or somewhere in that range?
So the big misconception, I think, for the consumer, and it's confusing, is if I buy a point, I'm going to get a point. Okay? So
explain what a point is.
I'm going to do that.
Okay.
So if you people think 1 point is 1%. Okay? It costs you 1% to get 0.25% of an interest rate. So if you're at 6.5, you pay 1% of your loan amount to go to 6 1/4. Okay, so it's not point for point. You pay the point, you get a 1/4 point. And so it takes a lot of points and dollars to bring that down. So there's certain programs, like you talked about, the builders, they build it into the sale price, especially in this market, because they have surplus inventory. So they want you to use the builder, purchase the property. They want you to use their mortgage company. They want you to use their title company. They want you to use their insurance company. And obviously, they're making money off of all of those.
Right.
So there's opportunity for them to give you multiple dollars, sometimes tens and $20,000 to buy these rates down, as long as they don't run into issues with. There's certain restrictions that with regards to the federal government and how much you can pay, and there's thresholds that you can't exceed. Okay, so obviously they'll make sure that they don't. But they're giving a lot of money for concessions and point reductions that are built into these services that they're offering. There's a thing called a temporary buy down. Okay, one of the things is it's called a 3-2-1 or a 2-1, and so what that is they're buying the rate down. So let's say it starts at, just for the simple sake of numbers, 7% is today's rate. They'll do a 3-year buy down, 3-2-1 buy down. So that means that it goes from 7 to 6 to 5 to 4. So the start rate is 4 for the first year. The second year it goes to 5, and then the third year, it's 5, 6, 7. I made a mistake. So it goes from, the first year is 5%, the second year is 6%, then it ends up at the third year, okay? But if they're going to give you $15,000 towards that, my philosophy is just use it for a permanent buy down. Why do temporary?
Right.
So you may only get, a portion of that. You may not start at that lowest rate, but you'll have, for the length of the loan, if you put the dollars next to each other, the temporary versus the entire term, and you do an amortization schedule, you're going to save more. with the permanent buy down.
And you do lending on new construction?
Sure, absolutely. I mean, unfortunately, I can't compete with some of the incentives that they're offering, but I know certain builders, if they can't do the loan or something, they will offer the incentive if somebody else can.
So I think it's important for people to think about this. Like, you may be in a sales office, you may be ready to affect a contract with the builder for new product, and they're going to be pushing, like you said, in-house mortgage, in-house title, in-house insurance.
I mean, it's smart business.
But it doesn't hurt to have you put your set of eyes on it and look, especially if you're in that 3-2-1 scenario where you could just use that money to have a straight line buy down
right.
at a rate that's locked in for 15 or 30 years.
Because the average loan stays in place for 5 to 7 years. So what that means is after that 5 to 7 year period, the property's either sold or there's a refinance put in place. So a 30-year term loan that starts eventually will either be sold or refinanced. And so, a temporary works, but if your end game and goal is, you're not going anywhere, and then you take the permanent buy down.
Got it. Good. All right, let's move away from kind of the mortgage stuff and the business side, and let's just get into some more kind of individual, more kind of personal stuff. Why? I won't say why, but what are some of the things that you just love about living in Southwest Florida?
Well, we got to start with the beach, right? I mean, we're close proximity to beautiful water. There's so many things you can do outside. I mean, I spent my weekend kayaking and at the beach, so there's so many things to do, and we have such fantastic wildlife here. I mean, dolphins and alligators, and birds are unbelievable. I find that stuff fascinating. Alligators are modern day dinosaurs, so they're pretty cool.
Yeah. No, I agree. I know you're at the beach a lot more than I am, but and then I see your photos online of kayaking and that type of thing. I think don't you do like every Sunday morning you kind of do a beach walk or something?
Yeah, I go to the beach on Sundays and I try and either ride my bike or kayak on Saturdays. So.
That's awesome.
Yeah.
It's a good work-life balance when you're staring at screens and making phone calls all week, and then you can unwind in nature. I think the other thing that you and I have in common is that we both love restaurants and food.
Yes, if you can't tell.
So one of the things that's interesting, because I am a absolutely abhorrent cook. Like, I always joke that I'm great at doing the dishes, but I have like these 4-year-old shiny stainless steel appliances that look like movie props because they've literally never been used. And like, if you were to open my refrigerator, I'd have like the amazing mustard that you got me in Cleveland.
Oh, yeah.
And then
the Burtmans? I got you the Stadium mustard. Yes.
Stadium mustard, but you also got me some Burtmans.
Okay.
It's a little plug for Ohio deli mustard.
That's right.
Unbelievable. Cleveland area's got that's the stuff.
It is.
And then just other condiments. It's hilarious. It's like you open the fridge, there's nothing there. But we both like to eat out, and it's funny because like you'll post a meal of a restaurant, or you'll tell me or text me like you have got to go to this place and eat, and then vice versa. So we're kind of like one-upping each other on this like little race back and forth of which places we like to eat and which we don't.
Yeah, there's a lot of good restaurants here. I mean, I like to go to the restaurants that obviously are locally owned. They can use them, because we with season, they're busy during the winter and they slow down during the summer. So it actually makes it great for us because you can get in without a lot of problems. But there's so many good restaurants to choose from down here.
Yeah, for sure. I agree with you. I'm also one of those people that tries to support the mom and pop operations here. They used to have a consortium of restaurant owners called Naples Originals, and those were just like not the corporate entity. So like the local Italian restaurant, but maybe not the big publicly traded outfit that has 400 locations in the United States.
Yeah.
I think we're both of the same mindset and try and do that. I think the other thing I want to talk about too is like you mentioned, and then just kind of getting back into the mortgage world and business world. So one of the things that I pride myself on is my ability to be responsive, and my ability to be accountable with my customers and kind of understand where everything is at any given time. Certainly if I'm with a customer, I'm asleep, I can't answer my phone, but immediately upon being finished with the customer or out of an appointment, I get back and get in touch. And you're a lot the same way. Can you explain to me, you mentioned earlier, like, hey, at least once a week we'll be talking, but can you give a little bit more of a breakdown of what your process looks like once a loan is submitted to you and they're going to go with you for the loan? Can you walk people through
Absolutely.
a typical process?
Yeah, so, once you send me the executed contract, we're going to start with doing a formal loan application. So what we do is we'll send out a letter to the buyer right away, which is what we call an additional items needed list. So because initially we just got preliminary documentation. We've got their income, we've got their bank statements, we've got their tax returns, all the stuff that we really need just to get started. Now we're going to formal loan application. So we got to get picture IDs and just contact for employment, just more information. So I send that initial letter out to them saying here's your items needed, and within 24 to 48 hours you're going to get an email with a link to sign the loan documentation. And the simplicity of it in 2025 is you click the link and you go through and you can review everything and you can sign everything digitally. Okay, and one of the things I say to them is if you have any questions, call me. We'll go over we'll address those questions. And at that point, we also have a document that's signed that's called an intent to proceed. So that tells everybody involved that they're going to go ahead and proceed. And at that point, we go ahead and we order the appraisal. Appraisal gets ordered, and that's a process. One of the working parts that we don't control, which could take anywhere from 7 to 10 days is typically the amount of time that the service provider has to get it back to us. Okay. And it depends on the type of property. If it's a single family, it's easier. If it's a condo, there's more documentation that's needed for the appraisal. If it's a manufactured home, all these different types of scenarios. So we kind of try and set the expectation up front with the borrower that this is from the time you sign the paperwork, and once the paperwork's signed, we'll order the appraisal, the loan will go into underwriting and start that process while we're waiting for the appraisal. Make sure you start working on quotes for homeowners insurance and or flood insurance if applicable. If there's a condo, we have to get the condo docs, which they have a service level requirement that they have to get them back to us in a certain time. Another third party working part that we don't control. So it depends. So there's all of these factors, but we try and set the expectation up front. The loan goes into underwriting. Within 24 to 72 hours, the loan's underwritten. So we have the conditional loan approval. What is a conditional loan approval? It means that the borrower's approved, and now we have to meet these conditions. Okay, so one of the conditions is the appraisal. One of the conditions is insurance. One of the conditions is verification of employment. If they're self-employed, sometimes we have to get letters from CPA. So there's every situation is going to be completely, specific to that borrower and the conditions are what we spend the majority of the time completing.
Right.
And then once all the conditions are completed, then the loan is cleared to close.
It's almost like a checklist, right?
It is a checklist. And 9 out of 10 times we kind of know what we're going to get asked for. So we've already asked for most of it, but sometimes, while we're waiting for them, we don't wait to get the loan into underwriting. We get it in, and then we work backwards to get those conditions.
Right.
So, and like you said, there's certain things that they don't know. So our job is to communicate with them, and our job is to communicate with our realtor partners. So we do send out an update to both sides of the real estate transaction every Friday morning, or I should say every Friday. It doesn't necessarily mean morning, and then we stay in direct communication, whether it be myself or my assistant, talking to the borrowers as we're going through, telling them what we need, why we need it, and working them to the close date.
Great. Yeah. No. I think it's important that people understand the process because it's foreign to some people, and some people maybe haven't done a mortgage in a while or don't understand what's different. One of the things I wanted to talk about, and I don't want to delve too much into the insurance world, but there's some things that have changed a little bit. and I know that are on our radar. I mean, you mentioned flood insurance, right? So FEMA devises these flood maps, and then they're every few years they're updated to that type of thing. There's an A floodplain, which is kind of more perilous than an X, like Xerox floodplain. And so it's important that we understand some potential hills we have to climb before we even write the contract. I know I've had conversations with you historically. We're like, hey, this house is here. I think it's in this floodplain. Can you double check? The roof is this old. The water heater is this old. Can you maybe speak to some things that you've seen or anecdotally you know that,
Sure.
that are a little bit problematic and maybe workarounds or best practices with those things?
Yeah, so I just know enough to be a little dangerous. So with flood insurance, I would say in the last year and a half, maybe two maximum, they redid the way they calculate the flood zones, in the sense that everybody used to get an elevation certificate. If you're at a specific elevation, then you don't need to get insurance, flood insurance. Well, they did away with elevation. It doesn't matter anymore. Now it's proximity to the water source. So obviously, the closer you are to the beach line or the lake or the river, that is going to be the determination of whether you are in that floodplain or not. Okay, so that being said, certain people, myself included, have recently been removed from a particular flood zone. Okay, so I'm like, do I need to keep my flood insurance? So I'm just having this conversation as of last week with my insurance company, and they're like, well, if you don't renew this policy and they put you back in a flood zone, that $900 policy a year will start at $2,000. So, so that's some of the things that I've learned. With regards to, it used to just be able to just get that flood elevation, and it wasn't, if you were above certain height, you didn't need it, but that's not the case anymore. It's all about proximity. And then you talked about roofs. So the insurance companies treat roofs so much different here in Florida, So you've got asphalt shingles, you've got tile shingles, and you've got metal roofs, okay? So the insurance companies look at a asphalt shingle and they give it a life of 15 years. Okay. Even though the shingle says 25, 30 years, right, you got 15 years on it. And the insurance
companies for cutting the useful life in half.
You're done. Yeah. Tile, they'll give you 25 years.
Okay.
And then metal, which is a lifetime in roof, piece of equipment that'll go on the roof, they'll only give you 35 years. So, I just had to spend money to replace my hot water tank in my garage because it was 15 years old. In order to save $1,000, it cost me $1,000. Right. And it was perfectly fine and working, but in order to get insurance, I had to replace the hot water tank. So 15 years is the length on a hot water tank.
So really important before you execute a contract, before you purchase insurance, before you do these things, it's really important to speak with somebody like myself that's been doing this for a long time, as well as Steve, and understand what some issues could be potentially for insurance, binding insurance, especially when you're getting a loan where you're mandated to have requisite types of insurance, whether it be flood, contents, the different types of policies and that type of thing. This isn't to be a scary thing. It's just like eyes wide open, understanding the process, understanding the current landscape and how laws are working, and getting through the process, binding the insurance, and being able to close on the property, right?
Absolutely. Yeah, I mean, it's a factor. I mean, if you have a 17-year-old roof and it's an asphalt shingle, can you get insurance? Yeah. Because you can't close on a home with a loan if you don't have insurance.
Right.
And that's the struggle.
All right. Hey, just to wrap up here, if you just want to maybe just say, why would I use Buckeye Lending versus XYZ Bank or that type of thing? What do you do differently, or maybe a quick 30-second elevator on Buckeye Lending, and why do you use Steve Fishman and Buckeye Lending?
Well, I appreciate that. So, yeah, Steve Fishman, Buckeye Lending, we know the market. That's one thing that's important, and we have products for the gamut of the excellent borrowers to the less than perfect borrowers. For properties that are in great condition, that are a little less than perfect condition, and we can compete with the biggest banks on the corner interest rate wise, and then our service is second to none. I mean, the communication, we've learned the most important thing that we can offer to consumers and our realtor partners is communication. If there is a problem, we're going to tell you about it. Doesn't mean it's a dead deal. We're just going to tell you that we have a hiccup, we're working on fixing it, and we're going to just be forward about everything. And that's one of the things. Communication, speed, and we're knowledgeable. We a lot of times can turn a no into a yes.
Awesome.
So I appreciate it, though.
Yeah, well, Steve, thanks for coming for the very first Naples Chad podcast.
Thank you.
I'm Chad Phipps with John Irwood Properties at the Vineyards office, and would love to talk to you. If you have any questions on mortgages or what's going on, you can email or text or call me. Or you can also, I'll put in the description contact information for Steve Fishman and Buckeye Lending and his email and cell phone numbers. If you have any questions on that or just want to even see how competitive Steve can be on things. Thanks for your time, bud.
Thank you. I appreciate it.
All right. Good to see you.
Good to see you.